Hello everyone, welcome back to my channel. So this video marks the end of the week number 49 in this Road to 100k Realized Return Challenge, and overall it was a positive week. It was a short week, only 4 days. Markets were closed yesterday, July the 4th, because of the Independence Day of the United States. But even so, markets continue their ascent upwards towards new all-time high, and especially over the last trading day on Thursday. I will show you here the QQQ, and as you can see here, looking at the week chart, it remained pretty steady. So the week started here on the 30th, so let's zoom in here. So it remained somewhat stable here, but then it gapped pretty much here on the last trading day, and basically the main reason was because positive economic data about jobs came out, and that fostered the feeling that the US economy is going about just fine, and the job market is still resilient enough despite the looming threat of tariffs and all the uncertainty and instability that comes with it. And so this also gives some room for Fed Chairman Jerome Powell to continue to wait for the further developments on the inflation front, so that before he takes any action towards either staying put or lower interest rates, which is basically what the US President Donald Trump is looking for at this moment. However, as things stand at the moment, and according to what I just announced in the last video, basically we decided not to pursue selling more puts on the QQQ, because the index basically is reaching new all-time highs, and so we decided to focus on the IWM, which is the index that follows the Russell 2000 index, which are basically constituted by the 2000 smaller capitalization companies in the United States. So it's a small cap index, by nature is a little bit more volatile, but even so, the market basically continued here, and basically it started this week. So it remained stable on Monday, but then over the next few days it went up steadily, and basically that's the reason why our puts here expired mostly worthless for the most part. There was a scary moment here on July the 1st, because as you can see, I had to roll over several positions here on the IWM, and here, as you can see, and rolling over because the options kept becoming basically worthless as the market went through this particular rise over here. But then as we reached the 200, we sold the put on the 218 strike price over here. The market continued to come down, and eventually these puts were in the money for most of the closing stages of the trading day. And at the time, when the market closed at 10:15 a.m. here Central European time, the index was clocking at around 217.9, something like that. So I was really under the expectation that the puts will be assigned, and I would be forced to buy these 700 shares on IWM. However, for some reason, the trading day ended up with a formal closing quote of 218.01, which means that these puts expired worthless, which were exactly what we wanted. But still, it was quite a quite a hairy moment. Now looking back with 2020 hindsight, it would have been better that we were assigned, because the index continued to rise on the next few days, and that would allow us, of course, to sell calls, very profitable calls, at least breaking even on the strike price, selling calls at 218, or if we even sold calls at 219 or 220 in an attempt to gain some profit out of the sale, some capital gain. The shares would have been assigned because the index continued to rise over the next few days. So at the time I was very relieved, but looking back, basically based on what happened during the next 2 trading days, yeah, it would have been much better the puts to have been assigned, but it is what it is, and of course there's nothing we can do about that. But still, it was a quite positive week for us. We managed to cash in 610, a little bit over $610, which, keep in mind, I know that for a few weeks back in January, back in January and in February, I think it was in February, we managed to collect about $1,000 per week, and the reason we were not able to get such result is because, first of all, this was a shortened week, only 4 days, and also because we are selling puts which with a lower delta. As you can see here, we are with, of course, with the exception of this one, because this is Pfizer. But when it comes to IWM, you see here the probability of profit that I just managed to capture. It was 89%. Here was a bit of an exception, 83, but the rest 96, 94. And here 89, 93. So basically these are, and this one is also an outlier, 84%, but basically the attempt is to try to reduce the possibility of being assigned, and to do that the focus is to try to sell 10 delta, meaning 90%, 10 delta put options. And so, because before we were trying to pursue 20 delta put options back in February, of course, meaning that there was an only an 80% probability of expiring worthless. The premiums, by the very nature of the options we are trading, had a higher premium, a larger premium, and so because of that, we were able to capture more premium out of that. Since we are now playing a little bit more conservatively here, of course, the premiums that we collect are relatively lower. But still, I think it's probably the safest route, because we don't know when the index will do over the next day, over the next 2 days or 3 days, and it's always better to not be assigned than to be assigned. But yeah, it was a quite positive week. Now there is a very interesting point when it comes to the Pfizer shares, because as we spoke about at the beginning of this week, we sold 25 strike price calls, 30 contracts, because we have a little bit over 3,000 shares. And the reason for that was, first of all, because there was a resistance level at around 24.50, and the stock was trading around 24. So we were there was a very strong probability that the calls would not be assigned, because the stock would not be able to rise towards the $25 strike price mark. So this was, of course, the expectation. However, on Tuesday, as you can see here, the stock just basically skyrocketed and simply burst through the 24.50 resistance level and ascended way beyond our strike price of 25. So now, as we stand at the moment, and these calls only expire at the end of next week, so next Friday, these calls are pretty much in the money. They were not yet exercised by the call buyers, however, so we still keep those calls alive. But as you can see here, they are very much in the money, and of course this is a losing position for us. But nonetheless, If we manage to sell at this price, we will have a capital loss, no doubt about that, but the premiums that we collected over time more than make up for this capital loss. So overall, considering the premiums that we collected over time and the capital loss that we will have if these if these calls are assigned, we will still come out with a slight profit. Of course, it would have been much better if we were able to sell the shares at a higher strike price, but I would never in a million years expect that the resistance would simply be cut through in just one fell swoop, and in just over the course of like 20 minutes. It was such a sharp rise, and yeah, there was no way we could predict that would happen. And so it's not the best scenario, but we are still okay with it. These things can happen. And so then once we sell these shares, the remaining 40 shares that we'll basically sell in the open market at a higher price. So we will still be able to collect some more funds on that, so not a problem. And we will use these proceeds here to basically pursue other strategies. And why I'm saying this, because today is July 5th, and earning season for the second quarter is coming thick and fast, and most likely I'm already surveying the market and the earnings calendar, and we will try to profit. We are not going to pursue the wheel strategy exclusively, but we are going to try to capitalize on the earnings releases that several companies, which ones I will still have to see which ones I'm going to choose, but we are going to try to capitalize on the earnings announcements of several companies. Now, I have already a set of criteria to select these companies, but I will disclose that at a later stage because I still have a few decisions to make in that regard. But basically what we are going to do is, and just to give you here an example, let's open here the Pfizer. Now keep in mind, I'm going to do this on companies that I don't have shares on. So basically what we are going to do is to attempt, I would say it would have been a double calendar spread. I already explained this strategy in one of my previous videos, but basically because we don't have the shares, we cannot do a full double calendar spread, because I don't sell naked calls on which I don't have the shares. But what we are basically going to do is something like this. We are going to buy, assuming the stock is at 25.42, we are going to buy a put, and let's just say, for example, that Pfizer has its earnings release. For example, let's just see right here. So Pfizer earnings date. So it's expected to report on August the 5th. Of course, this is an estimate, keep in mind, but assuming it's going to be on August the 5th, we are going to do something like this. On the option chain expiring the Friday before the earnings are announced, we are going to sell out of the money put. All right, so we are going to sell this put, or basically I'm going to explain the other way around. The Friday after the earnings, are going to be released. So August the 5th, the next option chain expires on August the 8th. So we are going to do basically a long strangle here. So we are going to buy this put over here, and we are going to buy this call as well. All right, and this is basically a long strangle, but then in order to reduce this cost, because this will be for each strangle that we buy, as you can see here, assuming of course these prices are maintained. Each strangle that we buy costs us $119. In order to lower the cost of this, we are going to come to the option chain here expiring before the earnings date, and we are going to sell a put. Remember, I cannot sell a call if I don't have the shares, so I would have done so, but assuming this is done on a stock in which I don't have any shares, I cannot sell a call. So this would be basically the cost. Instead of $119 per each straddle, we are going to basically it's going to cost us just 67 euros, so it goes almost by half. And what is the purpose of this? The purpose of this is that on the day, on August the 1st, on August the 1st, when this put is about to expire, what we are going to do, we expect that volatility will progressively rise because the earnings announcement is coming closer and closer and closer. And keep in mind that whatever moves the stock does, we are relatively protected, because if the stock goes down, these puts will appreciate in price, the call will become almost worthless, all right? But we have the puts more valuable, and so on this day we will basically unwind the entire position. So we're going to sell those puts, sell these calls, and buy back these puts. These puts may or may not be bought back, because, for example, if the stock lowers in price, if we don't buy back, we will be assigned. So we are going to buy this back because we don't want to be assigned, all right? And we sell these puts, and because this put is very valuable because the stock went down, we assume that the cost of this put, the value of this put, is higher than this one, because it still has some value in it, some more value that this does not have, because this still has more time premium. It still has more days towards its expiration date. So this, in principle, would be more valuable, because you can see even here it's always more valuable because of the time to expiration. And if the stock rises, these puts will become almost worthless, so we don't need to buy back this one. This one will just let it expire, but we sell this put back at a loss. But because this call will become much more valuable, the gain that we have on this call will offset the loss on this put, and because of we are going to let this one expire, we keep the premium. So this is how we are going to attempt to profit from earnings dates. We are not going to let, and this is a very important point to make, because you can ask, why don't you let also these calls and these puts expire, or you can just wait for the earnings to be announced. The stock for sure will make a large move to going down or going up, and so you can just then sell both of these options at a gain. The only problem is that if the stock does not move, the implied volatility of the puts and the calls will be crushed. This is the so-called volatility crush. And because of that, when I'm going to sell the options will not be worth nearly as much as the price at which we bought them. So it's, in order to avoid this volatility crush, it is absolutely fundamental that we sell these options that we bought before the earnings are announced. And since we already, when this put is going away or being assigned, so this is a perfect timing to do it, because the stocks, these options still have some time premium in it, which adds to the value at which we are going to receive with the sale. And of course there is still a high implied volatility in them, because we are still about 2-3 days away from the actual earnings date. And so that is how we are going to attempt to profit. And of course we are going to spread out our risk, because we are going to do this with very small positions but on many different companies, and because of that we know that some companies will not respond to the options on some companies will not respond as we want, and so we will make probably a loss on it. But the ones that will respond, it will bring us potentially a very, very large profit. And because of that, the gains we are going to have will most likely offset the losses that we are going to have, for sure. And this is the way we are going to proceed. I'm very much determined to do this, because the wheel strategy is still our core strategy, but it's mostly about a premium collection and does not take advantage of earnings releases. In fact, is counterproductive, because earnings releases are high volatility events, and since we are either with a wheel strategy selling puts or selling options, we are basically taking a short position on volatility, and so volatility works against us in the wheel strategy. And so by having these strategies in play, we offset some of our exposure to volatility, and we are able also not only to hedge our entire portfolio against some of that volatility, but we are also able to capitalize on it. And so basically that is how we are going to proceed, but more details will follow in the coming videos. For next week, these puts and calls are still live. As soon as possible I will probably buy back these puts, because these puts will probably go almost worthless by Monday or at the latest Tuesday, so there's no point in waiting for their expiration. We can buy those back immediately and do something else with the funds that will be released from the collateral, and we just let these calls go to the end, because at this point buying back would mean realizing a $1,500 loss, and yeah, there is no point in doing so. We'll just let the shares go away, and you never know, if there is a pullback in the price and the price comes back under 25, we still keep the shares. These calls expire worthless, and we are still get the opportunity to sell more calls on that, which is never a bad thing, especially because the price will not go back to 24, 23 for sure over the course of a week, and we are able to then to readjust our new calls at a higher strike price to attempt to not to have such a large or to have either a lower capital loss or perhaps even having a capital gain, but we will have to see. For the time being, this is all. Feel free to leave your comments in the comment section below, and of course feel free to send me a message on LinkedIn in case you have any questions. And as always, please like the video and subscribe to the channel, and we will reconvene next Monday. Next week will be a full 5-day trading day week, and so yeah, more premiums will be coming our way, and yeah, I'll see you there.